It sounds like July's been a good month, with equity markets performing well, bonds less so.
Despite all the uncertainties we've talked about for much of this year, we are sitting at all-time highs right now. UK market was actually the best performing globally, up 4%. And we've seen that continued negative sentiment towards US treasuries around the uncertainty of the Trump administration, and we think the broadening of markets will continue.
Hello, and welcome to July's Market Insight. I'm Olivia Reid, an investment manager in the private wealth team, and I'm here today with Craig Melling, Director of Investment. And we're going to be giving you a roundup of everything that happened in July, from Trump, tariffs, equity markets, and bonds to factors. So Craig, it's suffice to say the first half of the year was eventful. How has the second half started? Are investors still focused on Trump and tariffs?
Yes, July was certainly a continuation of what we've seen in the first half of the year, and it was quite a polarized month. The early part of July was dominated by policies, by tariffs, by the tariff deadline, and which saw some companies agree tariffs with the Trump administration and some having a bit more of an extended deadline. The market took some solace in that, though, although not ideal, and although at slightly higher rates than we had first anticipated. I think it was generally seen as a positive that there is potentially an outcome and an event such as a trade war has potentially been avoided. The second half of July, however, was a real focus back on companies themselves. We saw some of the world's biggest companies reporting their earnings, and investor sentiment and focus was firmly on those businesses.
And you touched on company earnings. Can you give us a little bit of a flavour of what we saw in the US and the UK?
Absolutely. And I think, as always, earnings season is dominated by the Magnificent Seven, those seven biggest companies in the world, which we have been seen and watched very heavily over the last few years because they've driven stock market returns. And July was no different. But actually, we saw the US do particularly well, but also the UK do particularly well. And those companies, those Magnificent Seven, had mixed results, but largely positive, and their earnings largely beat most of the rest of the world.
So we've touched on in previous videos that a lot of investors' focus in recent months has been on the US, but we've actually started to see increased flows into the UK and Europe. What's been happening in these regions?
So for much of the year, Europe and the UK have been in focus as we've seen that broadening out of returns away from those big behemoths in the US. July was quite different. So Europe struggled a little bit because I think there was still that continued worries around the Trump administration, what tariffs could be impacting European businesses. However, here in the UK, in local currencies, the UK market was actually the best performing globally, up 4%. And that's largely down to a strong earnings season by the businesses we have seen domiciled here in the UK, and that improving sentiment away from the US. So it's a real positive for UK equities in July.
So it sounds like July's been a good month and markets have had momentum. Where does that leave us?
Interestingly, despite all the uncertainties we've talked about for much of this year, we are sitting at all-time highs right now. Developed equity markets were up 1.3% in July. Emerging markets were up 2%, and many indices across the region are, as I say, at all-time highs, in particular the UK and US markets.
Turning now to defensive assets, what have we seen in terms of sentiment among bonds?
So fixed interest markets had a tough month in July. Actually, the broader market finished lower, and we've seen that continued negative sentiment towards US treasuries around the uncertainty of the Trump administration, and actually a bit more positivity around UK gilts, for example.
So negative sentiment towards the US, why has that come about?
So I think this all comes back to Trump, the unexpectedness of the tariffs, and actually his stance towards the Federal Reserve. It looks like he will remove the Federal Chair Powell over the next week or so. That's led to a little bit of instability, and the Trump administration is really looking to force down interest rates. They've got a clear objective there because that will help their fiscal spending, and that's just making the bond market a little bit uneasy and uncertainty around treasuries.
And how does this situation differ to what's going on in the UK?
Although in the UK, gilts were a little bit higher in terms of their yield over July, there's actually a bit more of an improving sentiment towards the UK and the policy. I think what actually was unexpected for July was a slightly hotter inflation print for here in the UK, and that's led by actually food consumption and transport and clothing. So inflation is still the big worry, and it's something we've talked about over the last few videos. But right now, I think when we look at bonds, it's a little bit uncertain, and I think that's been reflected on how they performed this year. But certainly we favour gilts over treasuries right now.
So we've spoken about equity markets being at all-time highs, and we know that factors are something that drives equity markets. How have the different factors performed?
Yeah, it's a really good question, and something we focus on a lot here at Progeny Asset Management because they run through all our solutions. Cyclical stocks have outperformed defensive stocks as investors have become a little bit more risk on with the prospects of growth higher. Small caps did really well for the early part of July and were leading the way. However, when we saw the earnings season in the final week, those big 7 tech giants pushed large caps and growth as a factor higher for the month. Notable earnings were from Meta and Microsoft, who beat expectations and had really strong share price runs post their results. Looking at the broader piece, value was actually the worst performing factor over the month, delivering 0.79%, whilst growth was the best, delivering 3.72%.
So it sounds like July's been a good month with equity markets performing well, bonds less so. What are we looking for going forwards?
Yeah, I think there's a real focus on valuations going forward. I think equity markets at those all-time highs, we can't be ignored, and also the valuations of the Magnificent Seven is something we've heard and talked a lot about over the last 12 months. But I think policy will still be in focus. The Trump administration and the impacts of the Trump tariffs are now going to be really in focus for investors, and inflation is going to be a key component of that. So all eyes will be on central banks and inflation prints over the next few months. And for us, I think we continue to favour a broad, diversified portfolio because uncertainty remains the only certainty right now. And although markets are pushing those all-time highs, we do have to have a bit of caution with what is going on around us. So broad market diversification, we think the broadening of markets will continue, and that use of defensive assets just in case anything unexpected happens. But really, that focus on inflation is probably the thing we're looking at for the rest of the year.